This is just a quick video on writing options as a strategy when volatility is low. There's always a inherent risk with writing options as you have no stop loss or anything stopping you from really large market movements, and your profit is limited. You're writing the option, you get the premium. And if the markets go against you, you're then paying the intrinsic value of the option, which is a large risk in itself. But if you're pretty comfortable knowing when sideways movements are coming up, and you're not going to get the large spikes, it is a handy little way to make some extra money. You're not going to make huge amounts off of writing options, but it is good to make that little bit of extra money, just to help out, get those extra percentage returns. One of the things you look at to start with is the news. There's not much happening. Mondays are always quiet days for trading. Always the quietest day of the week normally for trading. If there's no news on, then it's even better. There is a bit of an oil situation with the UK and Iran seizing each other's tankers, and a little bit of global, you would say, in the Middle East regards to that. I don't think it's going to be big enough to move the Aussie US too violently. I don't think you're going to get too much volatility in the Aussie US. You will in the oil market, and you might with currencies that are closer related to UK and oil, so the euro, the pound, and even the Canadian dollar is slightly more correlated to oil. So you might see some more movements in those sort of currencies, but the Aussie US should be quite stable. Now, to take advantage of the stability of what might happen, I write the option for it. So this is a chart of the Aussie US. I reckon you could go to any sort of date here on a Monday when there hasn't been much news. So I guess this was last Monday. Here we'll just have a look what happened last Monday in terms of news, see if there's anything. There's a bit going on. I didn't trade this one, and Chinese GDP is a reasonable market mover for the Aussie dollar. You wouldn't be trading that one. So if we go back a week before this one, so let's go Monday the 8th. Greek parliamentary elections are not going to change the Aussie US. Japanese sort of news there, speech doesn't move the market too much and definitely doesn't have much of an impact on the Aussie US. So a lot of yellows here and not too much market moving activity. You look here, even less so. So there's a high chance that the market won't be too volatile. It is just a high chance. It's never a guaranteed situation. Anything can happen. But to take advantage of this is where the skill, I guess, comes into it. It's easy to see these things, but to actually take advantage of it. The market for IG markets for options for in currencies opens up at 4:30 Australian Central Standard Time. This chart here is actually in Australian Eastern Standard Time, so 4:30 there is actually 4 o'clock in Australian Central Standard Time. So I'll take my gauge from here. This is just the idea of how to trade it. So this is an example of just what happened 2 weeks ago. You would have put on your option as soon as it opened up, because that's the time when the price is the largest, because options are made up of The pricing is made up of a vega, which is the volatility. The higher the volatility, the higher the price. Theta, which is the time to maturity, and its intrinsic value. That also has interest rates and dividends pricing in it, but this is a short day trade. We're not going to be any longer than a day. So dividends and interest rates do not come into it. We're only really concerned with the vega, the volatility, the theta, which is time to maturity, and the intrinsic value. When you're writing it, the actual idea of low volatility means the prices are quite low anyway. So you're actually banking on the time to maturity. You're hoping that the theta will go down to zero and you get the whole premium yourself. So if we look here at Monday at 16:30, 15th of July, I think I was actually looking at the 8th. So let's actually see what happened. The 8th of July as an estimate. Monday 8th at 16:30 there. So you'd look at that price there, which is 698, round up to 85. So the pricing of options would look at that as going 6,985 instead of 0.6985. Same thing. They just would price it as 6,985. Now, the highest sort of we can get an actual premium for it would be if you wrote your option at 7,000 and you wrote another option at 6,970. So you'd there and there. And the idea is it's the bandwidth. You want to stick within that bandwidth. So there's your high and 70 is your low. Cool. So now we actually it doesn't expire till 4:30 here, I believe. I can check here by just going to time. Oh, I'm on options actually. Let's go to the options here. And you can just check when it actually expires, which is that's Sydney time, so 4:30 my time, but it would be 5 o'clock on the chart. So it actually expires at 5 on Tuesday in the morning. So there. It would have expired around about, so it would have expired under the 70 but wouldn't matter because let's say that gets zero, you basically break even on that trade. You have still made your money from it not going above the 7,000 there. So you still would have made decent money. The idea, so let's go now. If we wanted to take this trade, it is a Monday. There is nothing much going on. You'd look at it at 70.37. So let's just go 7035. You'd go, basically, you only get about 15 pips up and down. Any more than that, it's zeroed off. You can't make money from that. So you would actually go 7050 and 7020. So what you do is you would buy a sell, which is a bit weird. So you sell a call there. It all depends on your risk level of where and how much you want to do. So that's $100 per point and 3.2. So if the price there doesn't go above 705, so if you look at the chart here, if the price does not go above 705 there, up until 5 o'clock here, so here. So if it doesn't go above the price there, you would make money. you'd make yourself $300 based on that. Now, the idea is you can also do the same on the low end. It's only $140. But, so then if it actually falls in between 750 and 730, no, 720. If it falls in between those two ranges there at 430, just put a vertical one in so you can see. Which is 5 o'clock time. So if it goes in between these, at that point, you would make the total amount of the premium. So the premium you're paying, well, the premium that others would pay for it. If you see here, that's the spread difference. So the spread that IG markets take, their fee is quite high. You're better off going with an options broker to get better spreads than that. But for ease of what I do, it's handy still to be able to use them. Yeah, so $310 you'd make plus the 130, so $440 is what you'd end up with, or $450 if I took it now, $460 if I took it now. Does change like that, but you'd have to. The idea is actually making the money on time to maturity. So you'd buy it, or you'd sell them, you'd sit on it, you'd let it close itself. Wait for that time to maturity to get down to zero. Vega would get to zero at time to maturity as well. So there is only the price of them are both at zero. So you get the whole. You buy it back for zero basically. You sell it for $310, you buy it back for zero, and you make $310 on one way, $140 on the other. That's a very simple way to see how you can trade low volatility. I will do another video explaining options pricing a little bit more. I'll do another video explaining how to straddle where there is high volatility, and I'll do another video explaining spike trades. Thanks.